Welcome to today's Environment and Energy Leader webinar sponsored by IsoMetrix. My name is Jessica Hunt, and on behalf of the entire team at E&E Leader, I welcome you to Mastering the 4 Steps in Sustainability Reporting. Please submit all questions today for the presenters over the next 25 to 30 minutes. We will do our very best to get to all questions before the end of today's event. But if we do not get a chance to answer your question, don't worry, because the team will follow up with you as soon as possible. At the conclusion of today's event, you will see a survey appear in your email. We do appreciate all the feedback that you can provide us post-event. This goes for those who are watching it live with us right now, or those who will be watching it on demand. And I know you are not here to listen to me, so without further ado, I'm going to introduce our speakers today from IsoMetrix. We have Alex DeLong and Marcelo Vargas. At this point, I'm going to turn the presentation over to Alex, and I will rejoin everybody for the Q&A session.
Thank you, Jess. Hi, everyone. Thank you for joining us today. I'm Alex DeLong, the Director of Product Marketing for IsoMetrix Lumina. And joining me is Marcelo Vargas, a Customer Success Leader on our team. Today, we will discuss mastering the 4 steps to sustainability reporting. So let's dive right in. When discussing sustainability and along with that, environmental, social, and governance reporting, one often discussed and somewhat unique component is maturity of the organization when it comes to their data collection and reporting processes. Today, we will discuss the 4 steps and how they may look different with immature organizations or those that are still building their foundations for sustainability reporting, and for organizations that have more established programs and initiatives, and how it might look a little bit different, but spoiler alert, no matter your background or maturity, the 4 steps to sustainability reporting will be the same. So start by defining your goals and metrics, measure your performance, evaluate your performance, and then manage results. It's just the content, the breadth, and the depth, and the outputs that will look a bit different. Starting off, let's look at step 1 for early stage sustainability and reporting programs. Now, organizations can have a long history of sustainability culture and initiatives, but when discussing maturity, much of it relies on the infrastructure to report on specific metrics, such as greenhouse gas emissions, water usage, energy usage, and waste across the organization, and the indirect impacts through its value chain. The first part of this is to identify reporting requirements, whether they be regulatory, such as those coming from the European Union, United Kingdom, Canada, Australia, along with many other major markets, or from investor demands, which is becoming more and more common with publicly traded companies and private equity-backed businesses, or even customer demands. We see this most commonly with suppliers to large corporations. Those businesses need to report on their value chain, and these companies that supply them need to provide this transparency in order to be able to keep the business of that large client. There are also voluntary disclosures. Common standards and frameworks include TCFD, GRI, SASB, the new IFRS standards, CDP, and many others. A lot of them are also specific to different industries. You might have heard of GRESB for real estate and some others. Many of the new regulations align very closely to these standards. So new organizations looking to start disclosing their sustainability goals and metrics will benefit from using these frameworks as guidelines. In a similar vein, many reporting frameworks have similar or overlapping disclosure categories and metrics. So mapping out which metrics overlap across multiple reporting requirements will save a lot of time later on with ensuring consistency and robust data collection. There's little worse than reporting different results to the same category. It can undermine the confidence in your firm's ability to report, quickly causing stakeholders to doubt the reporting quality from your organization. There are several components to getting feedback. The first part is to conduct a materiality assessment, which in the most basic form can mean looking at the entire list of reporting requirements and identifying which ones you're currently collecting on, to what degree, who the owner of the data is, and then gauging materiality of the metrics for which you are not yet reporting. For example, a small professional services firm where all employees work remotely, the scope 1 emissions may be immaterial along with production activities occurred in water stress areas, which is a category you might see in a framework, in which case the firm would explain their situation in the question response. This is something that's immaterial to our business or something that's so small that we wouldn't report on it. Firm, however, may want to pay closer attention to their business travel, since that could have a proportionately high impact relative to some of the other emissions categories. You don't want to report just nothing, saying nothing is material to us. This process will require input from across the organization. Frequently, executives or senior leaders in finance, human resources, legal, facilities, and security, including information security, are involved in this process, but it will also vary by industry. Environmental health and safety professionals, environmental scientists, or compliance officers may have bigger roles in certain industries. During this process, you will want to identify gaps in your reporting of those material topics and address how those can be mitigated and potentially filled. A final component that we have here will be to set your goals. For companies in the early stages, a straightforward goal can be to be fully compliant, being able to report on all the categories that are required. It's important not to take on too much in most cases. Trying to become net zero in your first year, if you aren't even anywhere close, can be a very costly endeavor. And in most cases, your stakeholders who are expecting such a report will, one, likely be lenient in the first year, not legal advice, but it's what we typically see. And two, can become skeptical if you do too much too fast. A big component with sustainability reporting is managing transition risk, or to explain it further, the transition from a current process or a conventional process to a more sustainable one. You can't do it all in one go. Moving too fast, one, is a big expense, and two, can be perceived as irresponsible when it comes to risk management. Goals can sometimes also be bestowed on you in certain cases. I know with the new regulation with Canada's major suppliers is to align with the government's goal of net zero by 2050. Setting the goal of net zero by 2050 could be what your company's goal ends up being. Hopefully a few years earlier than that will work, but from there, it's good to work backwards with science-based targets to create annual benchmarks that will provide natural goals to work towards as benchmarks. When looking at more established firms, the process will have the same basic components, but it will look different when you get under the hood. For these firms, much of the first step is addressing changes since the previous reporting period. Are the new mandatory requirements? Perhaps you expanded into a new jurisdiction in the past year, or new regulations have emerged where you do business, or a customer has informed you that they will start requiring sustainability reporting in their supply chain this year. Reporting standards can also change from year to year. They often make amendments every couple of years. So check if the standard producing entity has made announcements about changing their criteria this year. Evaluate your process. New materiality, such as changes that happen in your organization, like mergers and acquisitions, new products, new jurisdictions, they may impact what is material. So it's important to double check and see what impacts these changes to your organization might have. Do you have interest in expanding your voluntary disclosures? I always feel it's good to start with one when you're doing your report the first time, and then go into the second year. You'll see with a lot of large enterprises, they'll report as many as 5 voluntary frameworks, but majority of businesses, that would end up being overkill for them. And it'd be overkill for their demands and the resources that they can devote to this sort of practice. And then also look at within your organization, what has changed in terms of personnel. Are there personnel changes that will impact your data ownership? Are there unaddressed gaps that you have in the new materiality that need to be evaluated? Did you put in place some stopgaps in the last year that need to be addressed to have a more permanent placement? And then again, we're setting goals. Look at the progress in previous goals that you did from the year before or the reporting period before. If they're annual, do you want to do the next step or something similar this year in terms of reduction targets or percentage? If they're multi-year, were you able to hit those benchmarks? If it's a partial year, do you want to keep the same recurrence that you had in the previous period that you were reporting? Change things up a bit. If you're completing initiatives that you have that are fully successful, then what is the next initiative that you have to take on when you're looking to develop new ones? I know we do have a couple of customer examples, so Marcel is back on to share those with us.
Yeah, Alex, actually, you touched on a few key points. The first one that I want to touch on is the expanding standards. So with a new company, with one of our customers who's new to reporting, they're starting to align with certain frameworks and certain standards. And like you said, it's good to start off with one and then during the second year expand to more. And that's exactly what we're seeing, to be honest. So we have one of our customers who last year did have a report, and this year they just kind of reevaluated the process, looked at what they reported on, and then from there looked at the SASB standard and see how could they align with it better. This broadened their view, as well as this year they're hoping to be able to produce a better report with more details and more information. So that's a great place for companies to begin, and that's exactly what we're seeing with some of our customers.
That's great to hear. So moving along to step 2, we have measuring performance. And again, we're going to look at a less mature organization first, ones that might be developing their infrastructure for reporting and measuring. And you'll see at the bottom of the screen what is sometimes referred to as the golden triangle of people, process, and technology. It's a commonly used philosophy when working on different projects and processes, and it's no different here. So looking first at the people component, it's important to make sure your process knows who is going to be involved, who has access to the certain data that you need, and who's going to be responsible for that data. So looking at something such as facilities, if you have a facilities manager who has the data for what your water usage is, gets your monthly electricity bill, knows what the sources of that electricity are, and also has the metrics on what your waste is, that's going to be the person who has access and is responsible. When you're looking at some of the more heavy industry components or situations such as with manufacturing, perhaps there's an EHS person who is responsible, but perhaps there's a manager who has access and who's going to be doing the reporting. It's not always going to be the same person. When looking at the process, it's important to know the frequency in which reporting is going to happen. Is it going to be every month? Is it going to be every quarter, every year, more frequently than that? What are the data points that are required? And then is it reliable? And is it efficient? Is it something where it's going to take a lot of time for these individuals every time that they need to report? And can you make sure that this is something that's reliable? Usually, the fewer hands involved, the fewer manual processes, the more reliable it is. And can you attach what the evidence is? This is something where if you're looking at a power bill, for example, looking at the kilowatt hours or the kilojoules that are used, and being able to tie that in directly into what your reporting is. And then finally, the technology. What technology is used or can be used? Evaluate your current tech stack. And look at perhaps a break-even point for adopting new technology. What are the resources that you need to better support what you have right now? Do you need better outputs, better automation, or more automation, I should say, to make sure that your processes are reliable and efficient? One just kind of back of the napkin equation for your break-even point could be looking at your independent value variables, such as your sites and your data points that you have, and then dependent variables such as the full-time headcount dedicated to that, the responsiveness and timeliness that you need, the data quality, and then your technology spend, what it already is. And then say you have a person who needs to report monthly, it takes them about 4 hours to report on this. And then what is the cost of that headcount? What is their salary divided by 4 hours a month? And then multiply that by the number of people who are actually doing the same level of reporting. Now, if you're able to adopt a piece of technology that's going to reduce that to 1 hour a month, is that 1/4 of the amount of time for this full-time employee times the amount of similar people you have in that role going to turn into a return on investment, something that's positive, and is going to help you not only with the initial process of inputting the data and collecting it, but also the time it takes to audit at the end of the year and the confidence that you have in the data, making sure that it's high and that there's a lot less checking on in the background once you've gotten to the reporting phase. Again, taking a look at more mature organizations in this measure performance component, it's going to be a lot around monitoring, and the key elements here for continuous monitoring and improvement are going to be looking at the reporting cycle, what we have on the far left here. How frequently does the data need to be updated for reporting? How frequently should data be reported to identify trends? So taking a look at what you have from a macro sense, and if the trend is going in the wrong direction, what you're able to do in terms of pivots. If, say, for example, you have a carbon tax that you're being held accountable to, if in September or October of a given year, you're getting close to that threshold that you need to stay under, are there ways that you can pivot to minimize your penalty at the end of the year or perhaps avoid it entirely? And so having this clear view and transparent view into your internal systems and processes continuously through the year is going to be very helpful in terms of monitoring when you're measuring to get to that goal of your end of year reporting. And then also alerting and automated reminders. So automation of data collection is something that's a really big trend that we're seeing in terms of improving reporting efficiency and reducing the risk of human error. But I know it ends up being a lot of high costs, especially upfront and sometimes in maintenance, to be able to put these technological infrastructures in place. So in lieu of that, automating different components such as reminders for the data entry or setting alerts for anomalies detected in data, or perhaps when you're getting close to that usage threshold and you're able to find a viable substitute. These are things where having these alerts is going to be helpful in monitoring. And then finally, looking at the effectiveness of pilot programs. Now, not every organization is going to have these, but when we're looking at organizations that have done this type of reporting for several or even many years, you'll find a lot of times when looking to make improvements, it's a better practice to do it on a smaller scale before expanding to the entire organization or the business. One example of this could be looking at the light bulbs in a certain facility. If you want to make a shift using more energy efficient light bulbs, you might want to look at one of the facilities first and see the impact, or even other appliances. Say there's a kitchen in your office and you want to go to a more efficient refrigerator or oven or components like that. and then being able to see what the results are and adopt it or adjust it when looking to scale the initiative. Same can be done with looking at employee benefits. If you're doing it in a certain region, or perks is probably a little bit more friendly to talk about. And then also recruiting practices. If there are goals to improve diversity or reduce employee churn of certain groups, just making sure that you have a culture that supports these individuals so you can have a diverse workforce with you. These are ways that pilot programs can really be effective before committing too much when it might not work.
Yeah, Alex, you mentioned something about data automation, and I think that's a big trend that we're seeing now, especially with our customers. One comes to mind right away. They've been constant with their reporting in the past few years, and it's until this year that they decided to try to automate everything or more aspects of the reporting. So what they've done is they scheduled several forms. They've decided on what periodicity they wanted to gather the data. And from there, they automated the process of scheduling the forms and handing or distributing to all the right stakeholders to gather all that data. What this does is, one, it minimizes the amount of work that they're putting in day to day. So yes, it's an upfront cost or upfront workload, like you said, but in the long term, it becomes so much more efficient. And two, it takes away from that human error because, to be honest, it's very easy to forget if it's a quarterly form or annual form, to forget some parts or to schedule later. There's a lot of room for human error there. So it just eliminates that extra little bit, and it just ensures that the reporting and the data collection goes as smoothly as possible.
Yeah, that's great to hear. Love those examples. So moving on to our third step, and when you're looking at evaluating your performance, I'd say the first thing is to take a little bit of a step back and celebrate your achievement. These sustainability reports and sustainability reporting take a lot of effort. And it's important to acknowledge, even if you're not getting the results entirely what you would like, that you celebrate the effort that was done. This isn't something that there are decades and decades of specialists and educational programs dedicated to getting people ready and able to do this. The people who are the most seasoned and most knowledgeable about this have been doing it for 20 years in most cases. Certainly there are more that have been doing it for 30, 40 years, but that's very much the exception. And with the trend of this type of reporting becoming so much more prevalent in only the last 6 years or so, it's important to be able to celebrate again and acknowledge all the hard work that was done in putting this together. From there, again, when you're evaluating, look at your annual and partial year goals. Were they achieved? How far away did they land from the target? It's important to make sure that you're getting pretty precise to what you were looking for. Similar with financial reporting, you don't want to constantly be reporting every quarter that you crushed all the financial goals, that you were outperforming significantly what was predicted, or underperforming. If you're far away from what your target is, then it sends a signal to external parties that you might not be looking at the right type of goals. And so getting close is helpful, and then reevaluating and retargeting, maybe looking at the internal sources of data and your prediction methodologies to get a little bit closer to what you expect outside of certain extenuating circumstances that might arise during the reporting period. I'd say the next is look at your multi-year goals. Were you able to hit the benchmark that you set aside for this year? Again, this is something maybe looking at net zero by 2050 or 2040, and being able to hit those reduction targets, those reduction benchmarks that you're going through along the way to get into that end goal. You don't want to have it set up so, in 2048, you're looking to completely reduce all of your emissions to that 2050 goal that Canada is setting out for you. It's going to be important to evaluate it similarly as you would an end goal that you might have for a calendar year or financial year or partial year, and being able to amend. And then finally, looking at how the process went and tracking performance over time. So if you have technology that gives you the capacity to look at certain dashboards, or you're able to aggregate all of your data into a central area, then you're able to get a bit of a better view on what you have going for you. And again, that sustainability reporting people, they're in very high demand. It's not a very common skill set still. It takes a lot of cost and work to fully automate data gathering. So when you do have individuals who are working on this day in and day out, what is your cost threshold for keeping that talent happy and motivated and continuing to put in that effort forward? Obviously, repeatable and standardized processes make things easier, but are there gaps that technology can fill, and will that help reduce additional headcount and keep the current talent happy? So that's all part of evaluating the process, looking again at those people, process, and technology. Do we have the right tools, the right individuals? Are there certain areas that are lagging or that are outperforming what you're hoping for? And from there, we'll certainly move into the next phase, but we want to hear from Marcelo some of the customer examples that we've seen for this as well.
Yeah, thank you, Alex. We have noticed with our customers that the need for constant evaluation, is necessary, and it's important in order to track the process that they're having. So we find a key component for this is being able to benchmark historical information. I know you said that this is relatively new and a lot of companies are just starting to report now, but having the ability to gather historical information, see where the company was at before, and being able to track that process is huge. We notice our customers really value those, those dashboards or those tools that help them keep track of everything, see how far they are from their goals and what they need to do in order to achieve them.
Thank you. So moving on to the final portion, final step, is looking at your results and how you're able to manage them. So it's important to report objectively. Transparency is key here. And remember, they're called disclosures for a reason. It's showing what the current state is, how you're progressing along your goals, and what possible risks and opportunities there are for you in your current posture and your current processes. So it doesn't mean you have to be negative. It's just taking into account what's actually there and being able to explain areas that aren't necessarily where you want to be in your progress, and then share how you're going to mitigate that and what you're going to be able to achieve. And for things that are great achievements, definitely celebrate them. You don't have to make it too superfluous, but just share how important that is to your organization and tailor it to your audience. You might have different components that are for internal audiences versus external audiences too. I know a lot of times organizations, when they start off reporting, will do an internal report first before they're ready to share all the information to external stakeholders. Get necessary assurance. This is something that's becoming more and more common with auditing. Usually, Big Four or other auditing firms can help out with this, but getting that assurance on your reporting, making sure that your calculations, your data collection are sound. And this is something where technology also tends to help a bit with creating a more transparent data collection chain. And then finally, proposing areas for improvement, whether it's process-wise, building those better processes for data collection, for data reporting, data transparency, or being able to pivot during the collection process, and then results-wise as well. If you weren't able to hit what you were looking for, being able to do that the next time. Then finally, taking a look at some of our customer best practices.
So this is just a quick summary of some of the best practices that we tend to see from our customers. So starting with aligning with a standard. We see this both in customers that have already been reporting and tend to pivot or want to see where else they could report on or what other metrics they were missing out on. So this is a good way for them to open or broaden their view, as well as customers that are just starting to report. Like I mentioned, we have a customer that's new to this and at first was a bit lost, wasn't sure the right steps to take. So aligning with a standard just provides that guideline and the facility, it just facilitates the process of getting started with the reporting. The second would be the historical data. Like we talked about, having access to this historical data is a great tool. If the company can gather data from the past few years, they can see and understand where they were at previously and where they want to go. It allows them to benchmark and track their progress and to set realistic goals at the end of the day. Like Alex mentioned, you don't want to set goals that are either underperforming or way too unachievable. So this allows for better forecasting as well as better benchmarking and tracking. And lastly, enlisting the correct stakeholders. We found that ESG reporting is a job in itself. It requires a lot of time, a lot of patience, and having the right stakeholders facilitates all of that. If a company is starting off with the reporting, this is, I would say, one of the key components to having a successful reporting period. It just ensures that everyone within the organization is on board and they all have the right mindset to provide the best data, gather it the best possible way, and have a good report. So that's just a quick summary of what we've tend to see with our customers so far.
Yeah, that's great to hear. So that brings us to our conclusion. I know we have a couple of questions from the audience, and we'll bring Jess back on to help us with that. So I just want to thank everyone very much for your time today.
Alex, thank you. And Marcella, thank you so much for a fantastic presentation. I want to say again, thank you to the attendees for such thought-provoking questions that were submitted. We will do our best to get to as many as we can, but I can guarantee you we will not get a chance to answer all of them. But I've been assured that the team at IsoMetrix will follow up with each and every person who has asked questions, so keep them coming. All right, Alex, how much customization is required for reporting software?
That's a great question. I'll try my best not to do too much of a plug for our own product, but I do have a pretty awful answer for that great question. It depends. There are some software providers that will get you up and running out of the box in just several weeks, but others are more highly customizable and can take a bit longer to implement. So I'd say when evaluating a software provider, decide which components of your process are inflexible and which ones can be more adapted. Customization tends to have a high upfront cost, and updates tend to be a bit slower, especially as you get more and more customized. But you can get exactly what you envision with the system that will cater entirely to your process when you do a lot of that customization. Some of the more modern sustainability and ESG reporting products look to balance the best of both worlds, since reporting is highly situational. If you're in the financial sector, for example, you may think you need a solution specifically tailored to that industry, but there are solutions, such as ours, that are a bit flexible to report based on a fund or portfolio company, or based on sites or buildings if you're looking at a different type of industry. When thinking about required capabilities, it's simply a data centralization platform with workflows, audit trails, data visualization, reporting, and content aligned to this specific subject. Not to undervalue these types of solutions as a whole, it's just that the content and subject expertise differentiate them from other project management tools, for example. You'll need GHG calculations and the ability to upload your own custom ones, your own custom calculations and frameworks, and then have content for frameworks such as SASB, GRI, CDP, and IFRS. And so again, it kind of depends on what your level of demand is for that customization. There's a huge continuum when you're looking at different solutions.
I have no doubt, but thank you for providing such detailed information. You mentioned the financial sector, and what about the other industries you work with? So the different phases that you guys talked about in today's event, can you just touch a little bit on how the phases look different depending on your industry?
Yeah, I'd say it looks a bit different based on industry and geography. There's no one size fits all solution, but the processes will still remain similar, but the substance within them will be different. And that was a big point of this presentation, to show a lot of this is just good project management, process management, being able to define, evaluate, and monitor throughout. So first, you're always going to want to look at those mandatory requirements and address those. A lot of times by industry, you can have industry specific demands on you. I know finance with SFDR and the new Canadian regulation and a few others is usually the first place that regulators are going to look. And then it kind of expands from there to other industries. You're going to want to find out who owns the data. Often there will be an environmental health and safety person if you're looking at heavy industries such as mining or manufacturing, but that's certainly going to be less common in a retail industry. In retail, supply and distribution chains can be very complex. Same with product end of life when there are many products to account for. So it's important to look at your requirements, assess the materiality, and identify who the data owners are. If there are many internal or if there are many external or international ones, then you might find that adopting software earlier on in your journey is going to be more important to organize your reporting structure. So yeah, again, it's going to look a lot different by industry, but the core components remain the same.
Yeah, and that's a really important point to make. And I know we have questions still coming in from attendees. We probably only have a time for one more before we do some key takeaways. And this is a question that I think is extremely relevant and one that has come in a couple times. So at what stage does it really make sense to dedicate a full-time expert to this reporting, and what background should we look for?
Yeah, these people are a bit in short supply. It doesn't have the same sort of longevity or background or history as other functions within an organization, something like finance or accounting or operations, marketing, things of those nature, where there are decades and decades of people and a lot of educational programs to get that expertise. So I'd say it really depends on the scale and complexity within your organization, but the answer often ends up being pretty early on. If you think about building the infrastructure for data collection, holding folks accountable to their reporting, identifying and tracking progress for goals and benchmarks, and then producing reports on all of these, it becomes too much for any single person to handle as an add-on to their current job. Even if you might say that you're only going to use 80% of a full-time employee, if you're adding that to a current full-time employee, that's 180% of their job. And so it also gives a bit of a buffer to be able to scale up. Frequently, companies will employ consultants with sustainability reporting expertise to help get them started. And they don't want to, I don't want to offend consultants we have in attendance, but that can get kind of costly in the long run, especially if they don't have an internal point person within your organization. When you do hire that full-time employee, likely that person will want to make the reporting data collection process their own. So investing too much on the forefront of the process before hiring someone can lead to some sunk costs. In terms of that person, you'll first want someone who's passionate about sustainability, since they'll end up being the voice of the program, at least early on. Background in reporting to sustainability and ESG frameworks is a big plus, since they have familiarity with these types of data and can adapt to similar standards quite easily. Certainly data analysis, project management are important too. Writing is also good since they'll likely be synthesizing the data into your annual report and help with some PR and marketing. Lastly, I'd say the person should be personable and influential. Being able to be influential is important in terms of soft skills. There tends to be quite a bit of change management early on. Sometimes people reporting will feel that they're facing judgment based on decisions that they made years ago when they weren't being measured on sustainability as a factor. So having that personal touch will be important to get them and others on board with those new initiatives that you have.
Which, no, it completely makes sense. You want someone that has that buy-in. So, that's a bonus of having, an internal person, in this position. And from everything you talked about, it sounds like that this job is meant for more than one person because it's a lot. It's a lot. It's a lot. It can be a lot to take on at one time. But I thank you for mentioning the personable aspects because they are going to be dealing with stakeholders, internal and external stakeholders. So they really do have to be able to talk to a wide, range of people and backgrounds and abilities. So some really, really good points. And I know we are running out of time right now. And I'd love if, Alex, you and Marcelo could leave us with some key takeaways before I wrap up today's event.
Yeah, I can go quickly. I think it's important just to recognize that this is sustainability reporting is really a business imperative in a lot of ways. You're getting demands from a lot of different stakeholders, internal, external, regulatory, customers, coming from a lot of directions. And so good sustainability reporting is good business in a lot of ways. It's future-proofing you for your brand, for your reputation, and to prevent regulatory deficiencies or gaps. But then also it's good project management to have good sustainability reporting infrastructure. Think about a lot of the challenges that you're going to face in any sort of organization-wide scale projects that you have. And so being able to have good processes, have reliable technology, and then get feedback along the way and be able to pivot as needed, whether that's short-term or long-term, and be able to evaluate and continue forward in the long term.
No, great things to leave us with. All right, Marcelo, you're up before I close us out.
Okay, yeah, I think the last thing I'll leave everyone with and kind of what I've seen with the clients that I've worked with is that maybe it's not as intimidating as as you think. I think what I've seen, something key that I've seen with the clients is taking that first step is key and having that initiative. And then by then having a clear goal in mind, where the organization wants to be, where they want to be in the next few years compared to where they are now and what they have in place, that allows them to identify, all right, what are the next steps that we need to get there? And it's kind of similar, to, I guess, the stock market. You can't really time it. I think now is the right time to start looking internally at what they have and what steps they need to do or what they need to align with in order to be prepared for the future.
No, I mean, there's no better time than now to start. I know that's said and that phrase is used so frequently, but there are going to be so many more requirements coming down, in the EU, internationally, as well as in the United States. So you're going to have the data. You're going to have to be able to back the data up and show measurable progress. So thank you both so much, and as well as the rest of your team at IsoMetrix for this event today. Again, we appreciate everyone joining us live, and a big thank you to those who will be watching this on demand. And at this point, we're going to conclude today's webinar, and we hope everyone has a wonderful day. Thanks again.